Thank you for joining Avni and myself. I'm Stacy Francis, and we're going to be taking you through an important presentation and conversation about what's happening in the markets, a historical perspective of have we seen something like this before and how have the markets recovered, how quickly have they recovered. We're going to be talking a little bit about the oil price wars because I know that's on everyone's mind as well. And also talking about investment moves that you need to know about and how you can weather this very volatile time, one of the most volatile times we've seen in the last decade. I just want to say thank you for being here today. We are going to be having what we call weekly market roundups. And essentially every Monday at 8 o'clock, one of our team members, myself or Avni, will be here to give you a market roundup on what happened in the last week, what things are looking like for the next week, to keep you informed and keep you grounded. I think what's really important about going through everything that we're going through is to try and dial the fear down. And how you dial the fear down is by truly having more understanding and more knowledge. And that's what we're going to be doing and cutting through all the headlines out there to give you the real meat, the real information that you need to know to make good decisions. We're going to be recording this webinar today, as well as all of our future market roundups, weekly roundups going forward. Again, that's going to be every Monday at 8 o'clock Eastern Standard Time. We are going to be sending those recordings out, and then we ask you, please do send them to loved ones, friends, family, others who you know could benefit from the real information and having more knowledge through this time. I want to give you an introduction to a couple really fabulous tools that Zoom has. And the first one is your chat bar. And I've gone through and I've chatted a few times already with a few of you, welcoming you, and great to have you here today. Please use that as a way to communicate, specifically if you have any questions. And at the end, we'll hold those questions. We're going to go through all of them for you. And we can also, if it's something particular to your situation, we can also follow up with you afterwards after this call. We've cleared our calendars to make sure that we are available to answer questions and be there for our clients and all of our friends. With that, you can also see that there's a question and answer at the bottom of your screen, a question and answer section, and you can also put your questions there. And I'll be trying to answer a little bit throughout, but I also want to make sure that the quality of the presentation is great and that I'm not distracted. So without further ado, I'd love to welcome you. Francis Financial, as many of you know, we are a fee-only independent wealth management firm, and our specialty is working with individuals planning for the future, planning for transitions such as retirement, such as going through a divorce. We tend to work with people when they have the most influx in their life, and that's what we actually specialize with, and matching their investments to that. Today, I have one of my wonderful esteemed colleagues, Avni Ramani. She is our Director of Financial Planning and Director of Investment Management here at Francis Financial, and I couldn't be more thrilled to have someone here with such a high caliber, expertise, and knowledge that we're going to be sharing with you. So I'm going to turn it over to Avni, and we'll get started.
Good morning, everyone. Thank you for that introduction, Stacy. We just want to take you through, as Stacy mentioned, some of the current events and what's happening in the market. Just to go through the agenda, we'll talk about what's happening in the markets, a little bit of the historical perspective and impact of past such events, pandemics. We'll talk a little bit about oil price wars and what that is looking like. Economic outlook for the U.S., developed international and emerging market countries. There's a lot of different developments that happened even this weekend. Investment moves in portfolio positioning. We'll talk a little bit about what we're thinking around over there. And then top tips for successful investors, which I know we all want to be. and then we'll hold up for, we'll address questions that have come up. So just to take a quick look on what's happening in the markets, of course, there's a lot of fear, around coronavirus and its impact on the economy. A lot of people have fear about how that's impacting with all these, school closures and closing of restaurants and bars and, working from home, just the impact of all those things on the economy. And there are going to be some, we'll talk more about those, but there's just right now a whole lot of fear in the market right now. So what's going on? Well, the markets, all the indices, stocks, they're swinging wildly. Just on Friday, the Dow Jones Industrial Average jumped almost 2,000 points, about 9.4%. It was Friday the 13th, but it looked like it was a good one for the market. It was the biggest one-day point gain in the history of the stock exchange. Now, of course, the index started at a really low point, so that swing really, was accentuated. But that is to be recognized. The S&P 500 percentage change we've seen throughout the week, this past week and 2 weeks, it's gone up and it's gone down and it's gone up, and it's been historic really past couple of weeks. And to say that it's volatile is an understatement at this point. So some of the myths that we wanted to address, we've got a few questions from clients. They're worried that everyone is selling. And that's really not true. For a trade to happen, somebody has to sell and somebody else has to buy. So, it is mostly directed by institutional investors, and we'll talk a little bit about who those are. But it looks like for now, individual investors are not really participating that much in the market. These institutional investors have a huge stake in the market. The percentage of their trades is much higher, and these are the investors that are really causing the volatility. Who are these institutional investors? They're hedge funds, insurance companies, and mutual fund companies. They're commercial banks, pension funds. These are large players that have a huge amount of money invested in the market. And any moves they make have a real impact on the market. And why do they make these moves at times like this? There's a lot of pressure on them to show performance, to have that the worry that the investors have about their investments. These institutional investors are trying to take some of that off, and they feel a pressure to show action, and in trying to chase the market and chase the return. And so that's where it comes in, where these institutional investors are putting on huge trades in trying to chase that return, or at least fall in clients' portfolios. What does that result in? It results in higher fees, taxes, some of these inherent downsides that institutional investors face. And they typically trade more than 6 times as frequently as typical retail investors. So their trading frequency is extremely high because they're essentially worried about being fired. If investors see a lot of losses in their portfolios, these institutional investors are worried that they may get fired. So that's what's going on. And these are the people that are driving all the quant-based trading and algorithmic trading. So, it is these investors that are creating the volatility as well. We also want to talk about, your portfolio is not the market. When you see those swings in the S&P 500 and the Dow Jones Index, that's not the whole story. Your portfolio is made up of stocks and bonds, and depending on how aggressive your portfolio is, the weighting might be different. But just because the S&P 500 fell 5%, 6%, 7%, it may not mean that your portfolio is also down that much. So, just take a little bit of a breath and just try to remember that there are, we have instituted for our clients some of this cushioning in your portfolio already. So there is that buffer, there are those airbags that are in your portfolio that help from the your portfolio swinging as much as the S&P 500 might. And then, what does that mean for you when the stock market is having its panic attack? A lot of people, a lot of institutional investors want to move from risky assets to safe assets. The risky assets, for the most part, they're stocks. There is a flight to safety from these assets, and the safe assets are bonds. So there is this whole push to leave stocks and run towards bonds. In 2008, the same thing happened. Stocks lost 38%, but bonds gained 2%. And that's the whole point. Now, bonds are, again, not good bonds, should not be the ones also swinging back and forth so much as stocks. That's why they are the safe assets. And even amongst bonds, there is a differing variety. Where some bonds may have more of an impact of what's going on than others. So, try to remember that, each part of your portfolio has a function to perform, and bonds' function is to provide that cushioning in your portfolio at times like this. I'll pass it on to Stacy to share some historical perspective.
So the historical perspective, in fact, what I'm going to do is I'm going to have Avni just go to the next page. What I love to do in my spare time is look at data. And we put this chart together to share with you essentially how has the market reacted to past epidemics. And what we have seen is that short-term massive drops in the stock market. But in this chart, what you can see with all of these different epidemics, all of them barring one, and that is HIV/AIDS, which you see right there at the top, 6 months after, the S&P 500 was up. 12 months after, up even more significantly. And if we look at one of the more recent towards the bottom, Zika, that was back in January 2016, not too long ago, we saw that there was a massive brief drop in stocks as a result of that, but that 6 months later, we were posting double-digit gains. You can see that 12% return. A year later, we have that 17%. Now, what you can think about of each of these items, and essentially Fidelity International did a study specifically focused on epidemics that I read that I thought was really interesting, that epidemics tend to, again, have that short-term, very negative drop in the market, but that there tends to be a bounce. Now, why the severity of reaction to epidemics is such is because of the fear factor and the not understanding what the true impact is going to be. And I thought that was so insightful of that study, because that's exactly what we're seeing here today. People are having a hard time quantifying this information and truly understanding what the impact is going to be short term, medium term, and long term. If we go to the next slide, I wanted to show you this visually. I really liked this chart that was put out by Charles Schwab. As you know, Charles Schwab is one of our research partners as well. This looks at the MSCI World Index. So the S&P 500, 500 largest stocks in the United States. Now, this right here, we're zooming out to even a bigger view. This includes the S&P 500, but it actually includes all of the stocks, both internationally, developed international, as well as emerging markets. We're looking at the entire world of stocks here. And what Schwab has done is they've mapped out, going back from 1970 through 2020, before January, to see how did each of these epidemics impact the market. And overall, that same scenario that I spoke about that we're living through today, you can see very much playing across all of these different historical situations where there have been brief downturns and then a broad advances in the market overall. Now, does that mean that that's exactly what's going to happen now, that we have a quick rebound? I hope so. Most likely it's going to take longer because the fear factor for this epidemic is much higher. It's interesting, the death rate is not, in fact, many of these different epidemics had much, much, much higher death rates. But the social media aspect, we've never seen before, of information really trickling into you in every single way you can imagine, whether it's social media, it's CNBC and the news, it's the print media. You almost can't get away from it. And that's a little different than what we've seen before, again, creating a lot of fear, a lot of anxiety. And the background we have here is oil. And I don't know if you remember everything that happened with oil just a week or so ago, but that too is having a significant impact. And Avni's going to go ahead and talk you a little bit through what's going on, what the dynamics are. Does this matter? Are you going to be impacted? Are you going to see a lower price of oil at the pump? What are the pros? What are the cons?
Yes. And talking about oil prices, just there are two factors that are actually coming into play. One is on the demand side, which is there is a bit of a demand shock that's going on or anticipated to because of the coronavirus. People are not commuting to work, for example. People are canceling trips. There's a lot of reduction expected in the demand side for oil. And on the other side, what's going on is a price war between Saudi Arabia, Russia, and the US. So they are trying to increase, each of these countries is trying to show their dominance in this area and not agreeing to a price point for the oil. Saudi Arabia and Russia had a big tiff a couple of weeks ago. And so on the supply side, nobody's willing to take off the supply because of the decrease in demand. So the supply is continuing, and that's where the prices are falling. Now, what's going on is the US shale oil is one of the most expensive oils to produce. How they're financing that is by when the interest rates are so low, the oil companies, the shale oil exploration companies are able to take that low interest rate debt and pump that money into producing this oil. Now, that's how they're able to keep up with the low price structure as compared to the Saudi Arabia and the Russian oil. So that is going on in the background as well, but it's still more expensive to supply than oil from other countries. According to Moody's, there is an $86 billion due over the next 4 years for North American exploration and production companies. So they are, over the next 4 years, they have to pay back a lot of debt. They have to pay a lot of interest for this debt. And 62% of this debt is speculative. They are low quality companies that are holding on to this debt. So there is a little trepidation going on over there. How are these companies going to be able to pay back the debt? But now with the Federal Reserve reducing interest rates further, and we'll talk a little bit more about that, you know, things are changing as we speak almost. So, you know, the other countries like Russia and Saudi Arabia are in a better position because their costs are lower, and they are able to, and they have such established distribution systems and everything that they're able to better withstand these price wars. Now, who wins? You know, what is the impact that's going to occur? You know, of course, the shale producers are in a bit of a financial trouble, but that might actually work out for the consumers at the pump. The decrease in the prices as well as the decrease in demand will likely bring oil prices or gas prices down at the pump. I was reading a study, they were saying it could be down as much as 40 cents per gallon. So, you know, the reality, we don't know yet. Each state may be different, but we will see a significant difference in gas prices. Overall, because of the lack of demand and, you know, it may not have as much effect on this economy. Usually, if oil prices come down, the consumers at the gas pumps save more money, and that goes into the economy to be spent. That's usually how we see it. But because of this other aspect of coronavirus, we're not exactly sure that that is the impact we're going to see, because people are not going to be buying as much gas as they would otherwise. And you know, so the relationship has got a little muddied with this coronavirus in the background. Now, you know, when stock traders are responding to changes in oil prices, they are looking at the fluctuations in oil prices, and they're looking at how those fluctuations, what they indicate as far as the global growth is concerned. And so some of that is also built into the volatility that you will see impacting the stock market. For outlook, you know, the virus, there are a couple of different scenarios that analysts are running. The best case scenario is that the growth in the people affected by the virus peaks around March, late March, April, and then, you know, OPEC and Russia come to an agreement about the oil prices so that they're not flooding the market with oil. And that it doesn't have a significant impact on US growth. So, you know, that is one best case scenario that, has come up. And the worst case scenario is that the virus impact continues to grow past April into May and hopefully not beyond, but you know, that it continues to grow past April, and the OPEC and Russia keep fighting this price war. So that will be the worst case scenario if there's a combination of that. That's the worst case scenario that they've come up with. There's going to be a lot of high yield defaults in the energy sector. And this is one of the big reasons why for our clients' portfolios, we focus so much on having a high quality bond exposure. We don't want these high yields debt in the portfolio, because this is what fluctuates when there is this kind of uncertainty in the market. And that is not the job that we want bonds to perform in our clients' portfolios. So there is going to be a lot of effect of this. If this worst case scenario happens, it will impact financial institutions as well. And then the economy, there will likely be, definitely slowdown in growth. Negative growth is the worst case scenario, going into a recession. So that is definitely something that in a worst case scenario could happen. So we'll look at what our economic outlook is for the market in general, and I'll pass it on to Stacy to talk about that.
Thank you so much, Avni. Really excited to take you through this piece, because this is where we get into the real numbers, what things look like. I think the challenge is that it's very tough to map the impact of this when something is as nebulous as a health scare, especially when individuals don't know necessarily the extent of the impact long term. On the next slide, you'll see that there's a lot of things that you've done, that they've done in Congress to spur the economy. Just on Friday, Congress voted on an economic rescue package in response to the coronavirus, and essentially offering free testing, enhanced employment benefits, paid sick leave, as well as expanded food and assistance. So that definitely is a positive. I know that also we just saw over the weekend on Sunday, the Federal Reserve announced an interest rate cut to 0 and launched a new round of quantitative easing. What does that mean? That means essentially that individuals are going to be able to see lower interest rates on their credit cards. We're going to see lower interest rates also on our auto loans. But unfortunately, it also means that we're going to see lower interest rates on our reserve deposit. So our savings accounts are going to be dropping down. A positive is that if you are looking to buy a house, the mortgage rates on your home ownership is going to be about 50 basis points lower. So a very positive situation for individuals who are in the process of buying a home. The next page is really looking at the federal government, and we saw that they signed in an $8.3 billion emergency spending bill to combat the coronavirus. And what that really is going to be used for, about $3 billion will be going towards research for a vaccination. $800 million will go towards treatment, research for treatment. We've seen other organizations such as the Bill and Melinda Gates Foundation just kicked in $100 million as well for research for a vaccination. So these are all items that are going towards finding that vaccination, being able to also offer assistance to local communities. New York City and New York State are getting some of those dollars, although it's no surprise that we want more of those dollars to help them navigate this. And the next piece that you'll see is talking a little bit about the IMF. So the IMF came forward this last week on Wednesday. They actually put forward $50 billion of emergency financing, and it's meant to go and help low and middle income countries to help them cushion the impact, not only financially, but also from the perspective of making sure that their healthcare systems are able to cope with the situation. We've seen time and time again that developed nations with developed healthcare systems cope much better with situations like this. So even the IMF is kicking in as well. You know, what we're seeing also on the next slide, you'll see what corporations are doing, and companies such as JP Morgan, BlackRock, and others are testing out contingency plans. Actually, many of those have gone live today. Most of the financial services companies are now asking as many people as possible to work from home. Google, Twitter, Sony actually were some of the first and sent workers home over a week ago. We here at Francis Financial are also working remotely. What is unique about us is that once a month we work remotely anyway. So we put this in place about 8 years ago after Hurricane Sandy. We were out of the office for about, oh bless Avni, I think it was 2 months. And we were remote at that time and found that to be such a amazing skill that we had, because we were able to be up and running after Hurricane Sandy within 24 hours. So you can imagine that for the last 8 or so more years of working remotely, the entire team at least one time a month to make sure that we've got all the equipment, we've got the double screens. Our situation is as good as you could possibly ever imagine, because this is normal for us and we can work in a very efficient way. Many other companies can do so as well, and so that's very positive that companies are going to keep able to run, and that hopefully this will minimize some of that impact. But what is the outlook for the U.S. economy? Essentially, officials are saying that truly we have another 3 or 4 weeks until we're really going to know what impact this has. But overall, the environment and the economy were in pretty good shape before we entered this downturn. And on the next page, you'll see a little bit about that right there. And I put together for you just a couple key indicators, the things that we look at, the numbers that we watch to know how the economy is doing. And retail sales, and I put J. Crew. Now, J. Crew is because I love J. Crew. So does my daughter. We both have great taste. I don't know if you can tell, this is J. Crew too, from a couple seasons ago. But overall, retail sales were doing very, very well. In fact, January they were up well over 4% versus a year ago. So that was very positive. Also, new housing starts really looking great. We had over almost 1.6 million of new housing starts, so new houses being constructed, which is a much higher rate than we've actually seen in the last few years. On the next page, you'll see payroll. Payroll grew by a very strong 273,000 individuals. Unemployment is some of the historically lowest we've ever seen at 3.5% of individuals being unemployed, a very, very low and healthy number. And also for cars, we saw that sales of cars and light trucks versus a year ago was up almost 2% from a year ago, which was fabulous. And then also GDP. So GDP is gross domestic product. It measures the value of the economy, the economic activity in the economy. And what we've seen is that the update for GDP is up to 2.7%. They actually revised it upwards even for the American economy from that 2.7% to 3.1. Now, economists do admit that forecasting at this stage is very difficult, and that there's a very high degree of uncertainty, both with the coronavirus as well as the oil battle. So a lot to be spoken about, and a lot more to see. But I want to bring it back over to Avni, particularly looking at your investment outlook and your current portfolio positioning that you'll see.
Thank you, Stacy. I think I saw somebody's message saying that there is a red box on the screen. I am going to stop sharing this presentation for just a second to see what's going on over there. So please bear with us. We'll be right back. All right, I think that solved the problem, but if there's anything else, please definitely send us a message so that we can address it. Moving on, the investment outlook and portfolio positioning. We are looking at what's going to happen. How should we position our portfolio given all that's going on in the market? Now, right now, if history repeats itself, which we sort of seen previously too, that it does, staying the course and maintaining the focus on long-term goals of our, for which we've designed this investment plan, is likely what's going to help us come through this. And we are keeping our eyes on the longer term and thinking about what has anything changed in your underlying situation. And if it hasn't, then we keep with the profile of the portfolio that we already had. Now, just knowing that it's not that we're saying, hey, look, just let it be, don't do anything. We're always looking at how to tweak your portfolio. And a couple of weeks ago, we made those changes, made some changes, because we really believed that this was what was right for the portfolio. So we're constantly looking at investments within the portfolio, but this crisis should not be a factor of changing a portfolio position. Because if we change this at this point, first of all, we have to know what is the right point to exit. Is this now because stock market on Friday moved up 9.4%? Or was it last week where it was down 5.6%? So, knowing exactly when to make that change is one piece. And then, even if you sold investments, when do you get back in? So you have to be right twice. You have to predict the markets twice. You have to have that supervision twice to be able to make it at the best point. And we all know that nobody can do this consistently. In fact, several studies have shown that no one can predict the market twice, forget twice, even once, consistently. So we're not playing that game. If your portfolio is invested in a certain way, just let it be. If possible, don't look at all this news about the markets. And we know it's not possible many times, but keep with it. It is investors who stay within their allocation, stay with their portfolio over the long term. Those are the investors that come out winning this.
Avni, I want to chime in because you're so right, and this is, I think, the crux of everything that we want to be talking about today. Carl Richards is one of the top behavioral scientists in the area of investments. He has written books. He's a Financial Times columnist, and he says that investment mistakes are because of investor mistakes. It's the individual that is, because of fear, because of fear or greed, because those are the two areas that people tend to sell at the absolute worst times. And I'm excited that you're sharing this slide, because this is a slide that really talks about how investors have actually underperformed the market. And there was even a study done of day traders and how they underperform the market, because they cannot time. Warren Buffett says this as well. You cannot time the market. If you try to time the market, it's a losing game. It's a losing game, and you're going to find yourself, just like these studies have shown right here, to be underperforming.
Right. And so let me talk a little bit about what this slide is. Basically, it's saying that the investment returns and the returns actually realized by investors are different. And it's not that we're dumb or we don't know how to do this, but we're wired to avoid pain and pursue pleasure. So when we see our portfolio fall 5, 6, 7%, this innate reaction kicks in where we want to just get away from this pain of this portfolio falling and pursue the pleasure that we might find in investing or in staying in cash. So we're just hardwired that way. And that is the reason why investors make these choices about leaving the market, getting out of the market, selling their portfolio at just the worst time. This study particularly, and there are several, the slide compares all these different studies that have been done as a result of the behavior gap. It's a technical term. The behavior gap is the gap where it's almost like, you know, what we know we should be doing, but what we actually do, and that's the gap. And it has found that because of our biases, we could be our returns could be lower by anywhere from 1.2% to 6.5%, which is shocking. And this is the reason why we keep bringing it back that we need to stay with the investments in the portfolio, especially at times like this. And Stacy referred to our favorite investor, Warren Buffett, who famously said, be fearful when others are greedy and greedy when others are fearful. And, you know, not a lot of people take that advice, but we love to continue to remind our clients to take that advice. There's other studies too about smart money and dumb money. And of course, this is not to say that any of us are dumb, but it's these the differences that we see between long term. So smart money are people who are invested for the long term, and these can include large commercial hedge funds or institutions, versus dumb money that are short term, speculative. They are more of retail investors, people who are day traders, odd lot traders, and people who are trying to follow the market trend. And every time we see that if you compare the smart money, so the smart money is the orange line on the graph. The smart money is the blue line on the graph. Dumb money is the orange line on the graph. And the S&P 500 is the green line. Now, consistently, and it's not a mirror image, but consistently, smart money confidence and the dumb money confidence have been on the opposite ends. And that's because of what happens in the S&P 500. The dumb money is trying to chase S&P 500 returns, whereas the smart money is actually keeping ahead of those trends in the S&P 500. So, this is another graphic that shows to keep that eye on the long term and to keep focused on the long term. So that's what we profess, we do for our clients. Our portfolio, we start out, when we first start working with clients, is to figure out, given their inherent situation, given what's going on in their lives, what is the smartest portfolio mix? And maybe we start with approximately 60% stocks and 40% bonds in this situation. There are other combinations as well, but that's where we start. Now, during the course of holding this portfolio, life happens. Market goes up, market goes down, and the mix of these investments shift. So what we saw in December of last year, in January of this year, because the stock market was so high, what happens is the stock portion of your portfolio increases as compared to the bond portion. And what we do at points like this, when the tolerance level goes beyond what we have set, what we do is take some of those gains off the table. We sell from the stocks when they are high, we sell from there, and then we buy into the bonds, which are at a lower point. So by definition, we're buying low and selling high. And this is the discipline that we've instituted in our portfolios, in our investment philosophy, that we continue to practice. And this is why our portfolios are not taking as much of a hit and keeping consistent with that long-term outlook. So, right now, there's a fire sale going on in the stock market. Now, does that mean you put in all your cash right now, today? Not really. There is a lot of volatility. We still need to see what's going on, get some sense in the market. And once that happens, if you have cash sitting aside, this is a great time to invest. Again, not a knee-jerk reaction, not do it now, today, let's go, but taking that studied approach of what part of my portfolio is not up to mark, not in that tolerance level, where should I pull out from and where should I invest? So there is a very educated, very studied approach that goes into this. And I'll turn it over to Stacy for some tips for successful investors.
Yeah, so Avni, you had it 100% on the mark that is now a good time to put money in if you don't need it in the short term. So if you do need cash in the next 6 months, 1 year, 2, or even 3 years, it's most likely not the best place and time to do that. But if you're a longer term investor, so a great option, if you're able to increase your contribution rate to your 401k, you should be doing it if your finances can weather that. I know for us at Francis Financial, we give a profit sharing to all our employees in their 401ks. So they get thousands and thousands of dollars that Francis Financial gives to them personally. And we do that once a year. And we are doing everything we can as quickly as possible to get those dollars to all of our employees so that they can get it in the market sooner. And that's because they don't need their 401ks for another decade, 2 decades, 3 decades, or more. So if you're a longer term investor, and we've have a few clients that have sent additional monies, particularly for retirement, that makes a lot of sense. If it's money that you might need 6 months, a year, 2, or even 3 years from the line, you wouldn't put that in the market anyway. And so we wouldn't encourage you to do that. The next picture is your brain. And, I'm not a scientist, but I have done a lot of studying, particularly of behavioral finance, because behavioral finance is just a fancy way of saying how we behave to losses and gains in the market. And the part of our brain that processes gains in the market, losses in the market, is right there at the bottom, called the amygdala. And that is, many of you have heard of, that fight or flight area of your brain that has been there for thousands and thousands of years. It's that part of the brain when you see a lion in front of you, to make sure that you run quickly when you see that lion. So you look and you see that danger. Now, that being said, that same fight or flight that you experience when you see the lion, or actually I was jogging up in Vermont earlier this year and I saw a bear, that same feeling is how you feel when you look at your portfolio and you see whether or not you're going to, you see losses or you see gains. So that amygdala is really essentially hijacking your brain. And there's an actual term, you can Google it, it's called the amygdala hijack. And that's where that fight or flight goes into place. And if you look at the next slide, I thought this was a really interesting chart, because what it shows you that amygdala impact on your portfolio when there are stock market increases or declines. And so let's go over to the gain. So the way that your brain responds as far as the amount of pleasure for a $50 gain in your portfolio, it's a little bit of pleasure. But if you go to the left and you see the chart and you see how your brain responds with a loss of $50, the actual reeling of that, the pain and the discomfort, is approximately 5 times more intense than you saw the pleasure of that $50 gain. That's why when you see your portfolio now and you see the prices go down, which I am right there, I'm invested as many of you are. In fact, more aggressively than 90% of our clients. So I see those losses even more than any of our clients. And I catch myself and I know it's the amygdala hijack, and I just try not to be looking at it every day. That is the best advice that we can give you right now, is to not look at your portfolio every day. Studies after studies have shown investors who watch their portfolio on a daily basis perform worse, because there's a point when you're not going to be able to sustain the losses anymore. And just like I know not to have Godiva chocolates on my desk and having them tempt me all day, eventually I'm going to eat some of those Godiva chocolates. It's the same thing with this. So trying to put it away and know that with the right allocation, and right now in all of our portfolios, we have more bonds in our portfolio. They are more recession proofed than they've ever been in our nearly 20-year history. And that's because we were planning for some type of shock. There was such exuberance, prices so high in the stock market, heady prices, in some cases really not warranted to be priced so high, and gains coming so high. We knew that there was going to be a pullback. Now, we didn't know when, but we knew it was going to happen. And that's why your bonds have really been so important and key. On the next slide, I wanted to show you something that I keep in mind: gains. So what's the goal? How do you do well in the market? How do you gain in the market? I remember, this is my little mnemonic, and I love mnemonics, and it helps me remember things when things get scary. Gains, the gyrations in the market are normal. Allocation, your mixture of stocks and the bonds is key. That is what's most important and going to give you the predictor of how you're going to do long term. And while we're talking about long term, I invest for the long term. We're thinking, again, 5, 10, 20, 30 years down the line. And as that chart that we showed you before with all the epidemics and the MSCI World Index, of looking at all of the world stocks together, you see that it continues to go higher and higher. And that is the nature of investing. N, never let emotions drive decisions. That's what we're seeing now. And S, the most important thing, the biggest control you have over your portfolio and your return long term is S. It's savings. It's savings. That's what you have the most control over. We're going to go to Q&A, but I want to give you a little bit of a smile. So this is my puppy, Matilda. She's now 2 years old, even though she still acts like a puppy. And I just wanted to have you a little smile. There's so much going on. Sometimes we forget to smile and know that everything long term is going to be okay. But Matilda actually was up early this morning and drew this. And you know, the cone of shame, she's had to wear that before, particularly when she got fixed. And you know, she said this little cute cartoon. It's for your own good. You have to stop touching your face. So anyways, I can send this to you if you'd like to send it around to friends. But let's go ahead and get started with some questions, because I know we've had some great questions also. So one of the questions that came in was regarding the advice about not putting cash in the market. So if you need cash within the next 6 months, 1 year, 2 years, you know, where do you put it? And if you see a bunch of cash that has not been invested, should you put it in the market? How do you think about this? How do you plan? So, you know, if you do need money in the next, you know, 6 months to 2 years, we would say don't invest. Don't invest it unless, again, that is for longer term. And when I say longer term, it's to go into your retirement account that you might be touching in 5, 10, 20, 30 years. That being said, if you have an emergency fund, that should be anywhere from 6 months of your spending. We have some clients that even have 9 months of their spending. You know, you've got that cushioning right there. Hopefully, if you're taking distributions from your portfolio, you've got that piece as well that's already in very conservative investments, whether it's cash or bonds. If you have that piece for your current distributions, plus you have maybe $200 or $300 or $400,000 just sitting on the side that you don't need, that can be put in your portfolio for the long term, then I would say definitely invest it. That would be a great opportunity for you to take advantage of this market. But I say, again, if you don't have your emergency fund, that's the number one thing you need to do with that cash first. Then you need to make sure that you have enough money for distributions if you're living on your portfolio. Then and only after then, go ahead and putting it towards that longer term investing. Great. Any other questions out there? And
Stacey, we have another question about the bond prices. Last week, bonds were falling too, which seems to be an indicator of the coming recession. So yes, last week there was a fall in the bond prices as well. For the most part, these were bonds that had lower quality of debt rating. So these are more high yield junk bonds that were facing this pressure, which they do in times of volatility. And that's precisely why we have higher quality of bonds in your portfolio. Having said that, there are times when both stocks and bonds do fall or rise at the same time. They actually rose together too towards the end of last year, 2019. They rose together as well. 2019 was a bumper year for both stocks and bonds. So there are these, extreme cases when they could move together, but the function that we want them to perform is to be that buffer for each other. When stocks are high, bonds are typically low, and then when bonds are high in a situation like this, which makes sense, the stocks are lower. So it's not typical that we see both stocks and bonds rising and falling at the same time, but that's an indication of something that's going on externally. So there's a lot of pressure from the oil price wars, the demand pressures, the high yield side of the bond market. These are causing pressures on bonds to lower. So what does that mean? Is there a recession coming? There could be, but there is definitely more volatility along the way, and we won't know until, a recession is a look to the past. When people look at the data from the past 3 months, 6 months, and say, oh, we had a recession in these past 3 and 6 months. So we won't know that for sure for a while, but we have to be prepared for lower growth and in that scenario for sure.
Yeah. Avni, I'm glad you brought that up, and you talked about bonds, and I think it's really important to talk about this subject, that there are different types of bonds. There's what's called high yield bonds, and that's what I call the cocktail speak for what is really called junk bonds. And it's really, really important. If you're not a Francis Financial client, none of our Francis Financial clients are in junk bonds. We got out of those because we knew exactly what would happen. With a downturn, those bonds are being decimated because they're very low credit quality, and the companies to go bankrupt are those that are from junk bonds. We have very high credit quality, gold star, shorter term bonds. So I plead with you that you do check the credit quality of the bonds that you have, because the bonds that we're holding have done phenomenally well. And they will continue to do phenomenally well, and we put them in the portfolio as recession proofing to protect exactly against this. We had another question about refinancing, and I think it's really important. So the question was about refinancing a car loan. I'm also going to extend this to mortgages. So refinancing car loan, the best thing to do is to go in and talk to the auto company where you got that loan. It's not as often that you see that you can actually refinance car loans. The way that you get in on the lower the lower cost space, the lower interest on car loans is by essentially buying a car at that point, or going in and having a lease. That being said, never say no, and now is the time to call your auto loan, and now is the time also to call your credit cards to see if you can negotiate also a lower interest rate. It doesn't hurt to negotiate, and the worst that can happen is that they say no. And what we have found is a 50% success rate of our clients that actually go and make that call. With going and looking at your mortgage, my husband and I are in the process of buying a house up in Vermont. And just so you know, we are 100% moving forward and have not a concern about making this commitment. And we are going through the process of lowering our interest rate. We locked in, and because of what's happened this weekend, we'll lock in even at a lower rate. Knowing that buying a house, we've made sure that we have our fully stocked emergency fund. We have enough money to easily afford this in cash flow ongoing. So this is something we feel very comfortable with. If you're looking to buy a house and things were tight for you coming into the house, not sure if you could really truly afford it, but you were able to qualify for the mortgage, I would encourage you to think very carefully to make sure that going forward that you can afford those payments. Because if you were already stretched at your current mortgage or already stretched at your current housing costs, and this was a step up, that's not a smart thing to do, to put that extra stress on yourself. So reach out to us. We're happy to run some calculations and see for you, but you don't want to stretch yourself with big purchases that you are uncomfortable with, even in the best of times.
That's great. If anyone has any additional questions, please feel free to type them up in the chat box. We're just over an hour, but if there are questions, we can definitely stick around and answer those.
Well, I want to actually end, another one just came in, and I want to do a shout out to one of our participants, and she said that she is going to go into her HR portal and up her contributions to make sure that she maxes out her 401k as soon as possible to buy when the market is low. And I just want to say, congratulations, that's the right thinking. It is. And I also just want to say thank you so much, Avni, for being here today and sharing your insight. Thank you to everyone here as well. We're going to be doing this every week. Today, we went through a lot. It was an hour. Going forward, our goal is to keep this anywhere from 20 to 30 minutes and having a lot of the opportunities for questions and answers. But today we wanted to go through the entire outlook. There's been so much that's gone on over the last couple weeks, a lot to really get everybody caught up. Going forward, they'll be shorter. We're going to be going over week by week and all the new things. But most importantly, reach out if you have questions. If you know individuals that are secretly or silently worried about their portfolio, please do reach out to us and introduce them. We're happy to have a conversation and look at how they're invested and let them know if they need to make any tweaks or if they're okay the way they are. It's a scary time, and we want to be here for people to give you knowledge, to give you information, because with knowledge and information, it gives you comfort and peace of mind, and that's what we all deserve. And most importantly, stay safe, stay healthy, and try to help others. I've been baking cookies for our doormen downstairs, and I know it's for them, but it makes me feel so good too. So if you can try to help someone else in some way, whatever it is, it's going to not only help them, but it's going to help you through this time too. So thank you so much. And thank you,
you.
Avni.